This is part 2 of question 56. So we stopped in third part and the fourth part. Now we have to find third one using the information on dividend provided in question, and we have to assess whether or not the project would add value. So first what we have to do is we have to find without the large project what is the dividend. Okay. So let us go here. If the large project is not undertaken, you have to clearly mention that the large project is not undertaken and dividend growth rate is maintained at the historic level. Okay, and how are we going to estimate the company's value? Based on dividend valuation model. Why dividend valuation model? Because dividend is there, right? So now whenever you are given this type of question might appear in your exam about dividend, and when you are given dividend for many years, let's say for 3 years or 4 years, then you have to estimate the dividend growth, dividend per share, the dividend payout. So these are the things which are there in a dividend valuation model you have to calculate. So starting from 2003, 4, 5 and 6, number of $1 equity shares in issue. Of course, you need the number of shares. Otherwise, you cannot find the dividend per share. So to find the dividend per share, you need the equity shares in issue. And if you say it is in thousands, dropping down to 3 zeros. So 60 million, 60 million. Okay, so let us see. We need the information from this table. Okay. And by the way, before going to this, we have to read the dividend history we didn't read. So dividend history, expected dividends and cost of capital, year end 2003 to 6. You have been given the number of shares and you have been given the total dividends paid. It is expected that dividends will grow at a historic rate if the large project is not undertaken. So it will grow at historic rate if not undertaken. Here itself they have given. Expected dividends and dividend growth if the large project is undertaken. Okay. And the cost of equity capital is estimated. So you have been given the cost of equity capital. Okay, if it is undertaken, what will happen in 2007, 8 and 9 and in future years from February 2009. This is the upcoming, but that we'll read later. First we'll do without if the project is not undertaken. So if the project is not undertaken, if you see the total dividends, this is also in thousands, and the dividend equity is also 60, 60 and 80, 80. Okay, now dividend per share is dividend divided by your share. So in the first one it is 12,832 divided by 60,000, which is, and make sure that you write the currency. Okay, it is dollar 0.214. Keep it into 3 decimal places. Now based on this average dividend growth rate, you have to find the dividend growth rate. Whenever dividend valuation model is there and the growth rate is not there, you have to find the dividend growth rate when it is given for 3-4 years. Okay, so the formula is the oldest divided by the latest dividend divided by the oldest. So the latest, if you see, it is for 2006, which is 0.255, and the oldest is 2003, which is 0.214. It is not the previous one. Okay, it is not 2006 dividend per share divided by 2005. It is 2006 divided by 2003, because 2003 is the oldest and this is the latest or newest. So the latest divided by the oldest into how many years? It might look 4 years, 2003, 4, 5 and 6, but it is actually 3 years. 2003 to 4, 1 year, 4 to 5 another year, 5 to 6 another year, 3 years. So that's why this fraction is 1 to the power of 3 minus 1. This is the formula. It is okay, and you should know this. Memorize it. The latest divided by the oldest to the power of 1 divided by number of years. If it is 3 years, then 1 to the power of 3. If it was 5 years, then it will be 1 divided by 5 minus 1. It will be 1.062, which means it is 6%. Okay. Because after you deduct by 1, okay, so it will be 0.0602. That means 6%. It is always better to round up to the whole number, the growth rate. So expected dividend in February 2004 will be what? if we have to find for February 2007, that is the next year, you are only given till 2006, so you just have to increase it by 6%. So 1.06 into the latest dividend, which is 0.255. So this will be the expected dividend in 2007. Now, this is not enough. You didn't find the value. Okay. So the Lirio's estimate value or estimate of the value of large project is not undertaken is equal to what? First of all, we'll see this. The date is very important. At what date we have to find the value. Okay. As at, okay, so just read first part. You need BI, right? So in BI, dividend capacity is on 28th February 2007, prior to investing in large project. So 28th February, that's why we want to find for the next year. Okay, that is 28th February 2007. That's why we found out after. That's why we had to find that increase rate to find for 2007. Okay, which is this expected dividend we needed for February 2007. That's why we needed the growth rate for that. And also the dividend per share. Now, the estimate value of large project is not undertaken will be what? What is the value? How do you get the value? It is simply this dividend per share, expected dividend divided by cost of capital. Equity has been given as 12%. 12 minus growth, 6%. This is 4.5 per share or 360 million market capitalization, the total value. Okay, because it will be 4.5 into 80. Number of shares 80,000. 80 million. Okay, so it will be 360 million. Okay, this number of shares will remain same forever in 2007 also. Now, if the large project is undertaken, funds required for the project. What is the funds required for the project? It is 40 million, right? The initial investment. Then comes funds from the sale of investment. Okay, so first you need, and what are the funds from the sale of the investment? Basically, you have to deduct that. The total fund which you require for that big project is how much? 40 million. Out of that 40 million, that investment which we did, right? 40 million. Out of that, how much we are getting from the sales? Appendix 2, you have to refer appendix 2. Even in appendix, you have to refer another appendix. This is not even the main report. Okay. So fund from the sale of investment. This will be deducted. Okay. From the funds which you require for the project. Out of that 40 million, the sum of it is funded through sale of investment. Appendix 2 you have to go. So let's go to appendix 2 and see how much we have got. This is appendix 1.1. Appendix 2 is this. Okay, so appendix 2 basically they are referring to as appendix 1.1, this one. Appendix 2, yes. Sale receipt hedge. So here you have to select one. Why? Because if you don't select, you cannot use it for your third part, for your investment in fund, because they have told clearly that you are going to use some from here and some from your operation for the first 2 years, the cash inflow. So that's why usually when we recommend a hedging strategy, we don't select. We just say that you have to take and follow sensitivity analysis, further investigation is required. But here we have to select one. Some type of questions, if you see, you have to select one specific hedging strategy because we need that amount for investing in other projects. Okay. In that case, you have to select like here, forward, future, or this thing. Option is no chance. So based on the highest receipt, we will go for future. You can even go for forward also if you have a justified forward, but let's take future in this case. So future, okay, what is the amount of future? It is 23,127. Okay, but here they are going by forward. Okay, here they have chosen forward, but you can even take future also, which will reduce your this thing further. Okay, since it is not such a big difference between future and forward, you can go forward also, but option should not be the choice. Okay, then So the funds required from dividend capacity cash flows, the balance, which is 16,882. This is, okay, out of this, the funds required from dividend capacity cash flows. Out of this, how much you have? Dividend capacity funds before transfer to project. So what is the dividend capacity? How much you have from appendix 1? 21,642. You have to go further up and see. Okay, the dividend capacity, this one. And the 3 zeros, don't forget to add the 3 zeros. Okay, this 3 zero have to be added here. When you're writing, write it as a full number. So let us go around. Okay, so always refer to the appendix which you are using, so that it's very clear for them to go up and check. Like for me now, they have referred appendix 1, that's why I would go up and check in appendix 1. This saves a lot of time of examiner if you're writing appendix. So appendix 1, it is this. So that means they have more capacity, more dividend capacity compared to what they require. They require only 16,882, but they have 21,642. So what is it? What is the difference between 21, this one, and 16,882? The difference is this, 4,760. The dividend capacity funds left after transfer. Still there is some dividend capacity which is left after the transfer. Okay, so annual dividend per share after the transfer. What is annual dividend per share after the transfer? Okay, so the amount which you have is your dividend only. So that dividend divided by number of shares. So your dividend is 4,760,000 divided by what is your number of shares? 80 million. So what will be your annual dividend per share? It will be 0.0595. Now, next, annual dividend paid end of February in 2007 and 8. Okay. Now, we didn't read this part after we have taken the large project. We have to read it. This, so year end. Okay, year to end of February 2007. Remaining cash flows after the investment in 40 million project will be paid as dividends. Okay. So remaining cash will be paid as dividends. That's what we did. But end of February 2008, the dividends paid will be the same amount as the previous year. So 2007 and 8, it is same, the dividend. Year of end 2009, dividends paid will be 0.53 per share. Next, in future years, dividends will grow at an annual rate of 7%. So here, that's why 2007 and 8, it will be same only, whatever you have just calculated it. But 2009, end of 2009, it will be 0.31, they have told. And net new growth rate from 2009 onwards, it is 7%. Now you have to find out. How are you going to find out? The estimate of value of large project is undertaken. If you see it's a long calculation, break this into small pieces and try to understand. It makes it easier for you. Don't take it as a big one long calculation. You will not be able to do it. Even in your calculator also, when you put, try to break down into small pieces and write the answer and then put, if you're not able to do it in one go. Let's say for the first year, 2007, end of February 2007, it will be this into this 12% because cost of equity 12% to the power minus 1. Okay, or it is same as this only, or same only. Okay, so this is one part, first year. Second year, 2000, end of 2008. So this is 2007, this is 2008. Same amount dividend per share into this time to the power minus 2, because for the second year. Third year, this is third year, 2009. It will be 0.31 into to the power minus 3. Okay, coming to the fourth year. Fourth year onwards, it is in perpetuity, right? So when it is in perpetuity, the formula is this. You have to use that dividend per share 0.31. Only you know the growth rate, okay, into growth, increase it by the growth rate, divided by cost of equity minus the growth rate into this. You have to multiply again. That is your discount factor. What is it? 12 to the power minus 3, not minus 4, the last years. Okay, so when you add all, This is the last year's. After from 2009 onwards, it is 5.04 per share or 403 million market capitalization. How did you get 403? It is 5.04 into 80 million, which is 403.2. So you can make it as 403. Now, note, please note this, a discussion paper can take many format. The answer provides one possible format. Okay, so you can follow this format. Now, we are done with all the calculations. Our job is to go and fill the. So let's, before doing this, go to your requirements and see whether you have fulfilled all your calculation parts, especially. If this also you have done. Okay. Now you have to discuss the issues of proposed methods of financing the project. All that debt and equity and the issues of financing in this way. That you will write in your report. For that you don't have to do a separate working or calculate. Only your calculation goes in appendix. Okay, so let us go to the third one for the value. If you see, it is 360 and here it is 403 million. So you can see dividend per share increased. So you can see that value actually increased after the large project is undertaken. Now we are going to go back and write the report. Okay, but before we write the report, let me show you the marking scheme. Okay, so part A, up to 2 marks per well explained point. B is the longest, so appendices 1 and 1.1. These are the things you have to cover: operating profit, interest paid, tax for normal activities, investment in working capital, non-current assets, correct treatment of depreciation, cash flow remitted, additional tax payable. Next, appendix 2. For everything you are getting 1 mark, so make sure you're not wrong anywhere. Amounts received based on forward, then it is long contracts and purchasing call options, you have to write it. And expected future price based on linear narrowing of basis, yes. Closing future price you have to be able to calculate. Amount received based on future contracts, recognition of small overhead. That recognition is also you are getting 1 mark. Saying that it is immaterial, that is small overhead, 1 mark. Option contracts of future contracts purchased. Premium paid in dollars. Amount received based on option contracts, 1 or 2 marks for well discussed point. And reasonable recommendation, 1 mark for that recommendation. You need it later. See, whenever you need that hedging that amount later in some other, in that time you should be very clear that you cannot say carry sensitivity analysis and do. That time you have to select 1. Okay, if there is no such thing, then you can say carry sensitivity analysis, do this, do that. I mean, this is third part. Appendix 3 and project assessment. So estimate of dividend growth rate. Dividend growth rate prior, okay, corporate value prior, annual dividend per share after the transfer of funds to project, estimate of value after the project is taken. So 1 mark for each, 2 marks I can see for some. And estimate of value after the project is taken, 2 mark. 1 mark is for concluding comments on project assessment. In your report you will see. Now, discussion of issues. Okay, so limitations of methods used. First you have to write limitations of methods, if it's debt or equity. Then signaling impact of change in dividend. Okay, dividend policy, what is the signaling impact? The clientele impact of change in dividend policy. The rationale for not considering debt or equity, 3 to 4 marks. And other relevant discussions, 2 to 3 marks. For most of you, it is the hard thing is this one. To give other relevant discussions, we'll see what are those, and rest all professional marks for the discussion paper layout and summary and all. So that's it for the marking scheme. Let us now go to the report and try to fulfill it. Sorry, not report, discussion paper. I always keep forgetting. Now, I'm not going to refer. I'm sure you must be very fresh with the numbers in your mind. Okay, you can keep the numbers in front of you while I'm reading this background information, the whole discussion paper. So, 40 million at the start of the project. Okay, so this much. This is based on what your forward. Of this amount is estimated to be received from the sale of equity investment, appendices 2 and 3. Refer appendices. This leaves a balance of this much. Appendix 3. Which will be obtained from the free cash flow to equity. Can you see? Which will be obtained from what? The dividend capacity. This will be obtained from dividend capacity of this much. This is your dividend capacity. Appendices 1. Expected to be generated in the first year. However, this will leave only this much of dividend available for dividend payment in the first year. Meeting a cut in expected dividends from this one to this one. Appendix 3. Meaning a cut in expected dividend from this one to this one. The same level of dividend will be paid in the second year as well. Okay. Here you are not talking about the project, because for the project you are talking under a different subheading in different paragraph, project assessment. Okay, now that dividend cut from 0.27 to this, that 0.27 is given before in your case study. Okay. So if it is not, okay, you can find out like this. We'll go for the dividend capacity and see. Here, expected dividend in February 2007 is this. This is the expected. Okay, but because of the project, this is before the project. After the project, it fell down less. Okay. So that's why that cut in dividend from 0.7 to 0.595 because of the project. Now the project assessment. So based on the dividend valuation model, based on what, whenever you use some model, please mention that model. Based on this model, this is the calculation. You don't have to define what all the variables and what it includes, but you have to say based on some model. It could be any model. In this case, it is dividend valuation model. The Lirio's market capitalization, therefore, its value is expected to increase from approximately 360 million to approximately, so it increased from where to where? Show that increment, or just under 12%. Appendix 3. Okay. If you see this, it will be 403 minus 360 divided by 360. Okay, it will be 11 point something 9 something. Okay, so round up. So it is just under 12%. That's why they told just under 12%, that increase. So this was said that it will be beneficial for the project. Beneficial for the project to be undertaken. You have to say when it is beneficial or not. You will understand. If it's an increase, yes, it should be undertaken. So in this case, it is beneficial because 12% it increased. So it is beneficial. Now coming to the possible issues. When you're okay, so always match your answers, what you're writing in the discussion paper, with your requirements in line. Keep your requirements in line and see, this is done, yes, done. This is done, yes, it is done. This is done. Now you're talking about the issues, the fourth one. Okay, so possible issues, if you see 1 2 3 4. So since this is a discussion paper, this is not a report writing, that's why you can see numbers are here. It could be in any format. You can write like this, but it have to be explanatory. It cannot be short sentences or 1 or 2 words, not like bullet points. Okay, don't confuse this with bullet points. So what are the possible issues? What do you used? You use dividend capacity. You are taking money from there. So one of the see, this is how you come with possible issues. Okay, based on what did you use here? They told that you are using dividend capacity. Okay, first from the sale of European, that whatever the amount you are hedging from that, and then the rest is from dividend capacity. So for dividend capacity, what we use? Dividend valuation model. For that dividend valuation model, there are so many issues you can talk about. So your starting point is that dividend valuation model. This is how you answer. Okay, first point, dividend valuation model. It is based on what? Number of factors, such as an accurate estimation of dividend growth rate. First, number 1 point. Okay, under dividend valuation model, number 1 point, growth rate. This you can talk about. Issue number 1, growth rate. Okay, we assume or we estimate, okay, that it is accurate, the dividend growth rate. So an accurate estimation of the dividend growth rate or non-changing cost of equity. Number 2, cost of equity. We assume it is same. There is no change in cost of equity, but we know in reality it is not so. So a non-changing cost of equity and a predictable future dividend stream growing in perpetuity. We told after 2000 February 2009 onwards, the dividend will grow at that rate. Okay. So this is number 3. In addition to this, all whatever the issues you have in dividend valuation model in one paragraph, you write. In addition to this, it is expected that the sale of the investment will yield how much? This much of euro. But this amount could increase or reduce in the next 3 months. Right? Now we are going talking about the second thing. Sale of investment. We are taking money from here also to project that invest to finance that project, fund that project, right? 40 million this thing. But this amount can increase or decrease also, right, in the next 3 months. And the dividend valuation model assumes that dividends and their growth rate are the sole drivers of corporate value, which is probably not accurate. This line have to be there. We know that dividend and growth rate are the sole drivers of corporate value. That's what dividend valuation model assumes. That's why we have dividend and growth rate only in that formula. Because they assume that these two are the sole drivers of corporate value, but it is not accurate. It is probably not accurate. Value of a company derives from many other things. But since we have found the value of the company based on dividend valuation model, this we have to tell that growth rate and dividend, they are the sole drivers of corporate value, which is not true. Coming to the point number 2. Although the dividend irrelevancy theory proposed by Modigan and Miller suggests that corporate value should not be affected by a corporation's dividend policy. Okay, what is this dividend irrelevancy theory? Make sure that you know what it is. Not so much detail, but just you must have read it somewhere. Okay. Proposed by whom? M&M, Modigliani and Miller suggests that corporate value should not be affected by a company's dividend policy. Yes, we hardly see that a company's value is affected by dividend policy because we know it is affected by financing or investing decisions, but not dividend policy. There are 3 types of policies what a company do. One is financing, one is investing, one is dividend policy. We know, yes, financing and investing activities does have an impact on the corporate value, but not dividend policy. We didn't learn so much. Okay. In practice, changes in value do matter for 2 main reasons. Changes in dividends matter for 2 reasons. Why? First, dividends are used as a signaling device to the market. For the signaling device, you are getting 1 mark. We saw in the marking scheme. That's why first I took you through the marking scheme before I could have explained you the issues. So first, dividends are used as a signaling device based on dividends. Others can signal what is going in the company, if it has increased or decreased. So dividends are used as signal device to the markets, and unexpected changes in dividends paid or dividend growth rates are not generally viewed positively by them. Yes, if suddenly there's a change in growth payment or growth rate in dividend, it is not viewed positively. Changes in dividends may signal that the company is not doing well, and this may affect the share price negatively. Yes. Okay. Coming to point 3. Second, corporate dividend policy attracts certain groups of shareholders or clients. It does. Okay. In the main, this is due to personal tax reasons. So personal tax reasons, because of personal tax reasons. For example, higher taxpayers may prefer. Try to talk about taxation also in dividend. We can talk because the 2 companies have different tax rates. One is having 25%, one is having 20%. So, for example, higher taxpayers may prefer low dividend payout. Yes, because you are paying high as a taxpayer, you are paying high amount of tax. So whatever the amount you have, you want to keep it, you want to retain it for further investment in the business. You don't want to pay it as a dividend, so your payment reduces. So that's why you prefer low dividend payout. Okay. On the other hand, and lower taxpayers may prefer higher dividend payout. So this refer. Okay. That's why we are bringing tax. We are linking it with the dividend payout. How dividend payout will matter based on tax. If higher tax, low payment. If lower tax, high dividend payout. A change in dividend may result in the class changing, and this change may result in excessive and positive negative share price volatility. Everything are linking with the negative share price volatility. You can see change in dividend can have an impact on what clientele. This was for this also you're getting marks. It was there in the marking scheme. Point 4. Now whether it is point 3, point 4, point 5, it is up to you. You have to decide depending on the number of marks. Okay, it is not clear why the board of directors would rather not raise the required finance to equity or debt. Now, when you're coming to the fourth point, what you are saying, all those which has been rejected, why they are rejected, debt and equity, why it was rejected to fund the project. You have to talk about it now. So it is not clear why the board would rather not raise the required finance through equity and debt. Is it clear? They already told yes they will not raise, but it is not clear from the case study why they will not raise an equity. So you have to state that the board of directors may have considered increasing debt to be risky. Yes, they may. Just use the word may. You're not sure. But usually when someone avoids debt, one reason could be, what comes to your mind could be, they want to, maybe it will be too risky. Yes, debt is too risky, right? Your gearing will increase. You have to pay interest. It's a burden. So increasing debt to be risky. One reason could be that. However, given that the current level of debt, now you are linking it. What happening when you're having this level of debt and the interest payment you are doing? Given that the current level of debt is 70 million compared to an estimated market capitalization of 360 million in Appendix 3. Now you see how you are linking one appendix to another. Okay, 70 million debt you are linking with 360 capitalization. This is before the big project. Okay, compared to an estimate market capitalization of 360 million, you are having a debt of 70 million. Okay, and you got this from Appendix 3. Raising another 40 million through debt finance will probably not result in a significantly high level of financial risk. So do you think if you raise this 40 million, it will raise your financial risk further? No, because the 70 debt is very less compared to the market capitalization. So because you need 40 million, right, for the project, so to increase, to raise another 40 million by debt would not be such issue. It will not increase your financial risk very highly. That's why we are talking the debt and market capitalization. We are comparing. The board of directors may have been concerned that going into market to raise extra finance may result in negative agency type issues. Another one could be, okay, that going into the market for the extra finance or for the loan may result in what? Negative agency type issues, such as having to make property information public. Yes. See, when you are going in the market for the finance, for the fund, you require fund. What do you have to do? There are certain things, certain negative issues, agency issues could happen. You have to give up on some of your personal freedom. You have to make certain information public. And being forced to give extra value to new equity holders. Being forced to give extra value to new equity holders. Yes. Or sending out negative signals to the market. So maybe this could be some of the reason why you went for that way. Now, the last paragraph, areas for further discussion by the board of directors. These are other discussions. Okay, for this also 2 to 3 marks in your marking scheme you saw. Usually till that you are able to get something, you are able to, but when you have to discuss about other areas, okay, areas for further discussion, it becomes a little tough. Okay, now let's see what they have written. So each of these issues should be considered and discussed further by the board of directors. With reference to point 1, the board of directors, reference to point 1, okay, what is point 1? Dividend valuation model and all. The board of directors needs to discuss whether the estimates and the models used are reasonable in estimating corporate value or market capitalization. They need to discuss estimates and model, dividend valuation model, whether the estimates and also the dividend valuation model are reasonable in estimating the corporate value or market capitalization with reference to point 2 and 3. The board of directors needs to discuss the implications of such a significant change in. They need to see the implication. What are the implications of changing the dividend policy? Significant change in dividend policy and how to communicate their intention to the market so that any negative reaction is minimized. Basically, you are giving like an action, what to do, that they have to communicate so that their negative reaction reduces. With the reference to point 4, the board of directors should discuss reasons for any reluctance to raise finance through markets, right? They have to discuss why they don't want to go through the market to raise finance, why they are reluctant to it. Okay, so that should be discussed with reasons to the market and whether any negative impact of this perhaps less than the negative impact of point 2 and 3. So you have to see whether that impact of raising finance through this, not raising finance through equity and debt, is less than the negative impact from point 2 and 3. That is changing dividend capacity. That also you have to see. So that's it for this, and we are just left with two more questions, and then we are done with the revision kit, which is 57 and 58. Yahoo! And just one more question from March 2000, sorry, September December 2020. That is question 1, which we'll be solving soon. So that's it. Do take care. God bless.